Imagine you're a wealthy merchant in London in 1772. You wake up one morning and discover that your banker, the man you've entrusted for years, has vanished. His office is locked. Your money, gone. Not stolen by thieves in the night, but vanished through something far more insidious, a web of invisible credit that existed only on paper. Now, fast forward to 2008. Lehman Brothers collapses. Bear Stearns implodes. Trillions of dollars vanish overnight from the global economy. Different century, different technology, but strangely similar circumstances. What if I told you that the 2008 financial crisis wasn't some modern anomaly, but actually a 236-year-old rerun? Here is the twist that should terrify you. The very first global financial crisis, the one that crashed economies from Amsterdam to Edinburgh in 1772, was caused by shadow banking. Not the regulated banks you see on every corner, but a shadowy network of credit dealers operating just beyond the reach of oversight. Sound familiar? The 1772 crisis destroyed fortunes, toppled empires, and even helped trigger the American Revolution. Yet today, our shadow banking system is bigger than ever, estimated at over $200 trillion globally, far surpassing the traditional banking sector. History isn't just rhyming, it's screaming at us. And the question isn't whether we repeating 1772, it is whether we have learned anything at all. By the end of this talk, you'll understand the hidden pattern that's been destroying wealth for centuries, and why it might be happening again, right under our noses. This matters because shadow banking touches your life, whether you realize it or not. When these systems collapse, they don't just hurt billionaire investors, they wipe out middle-class savings, evaporate pension funds, eliminate jobs, and can even destabilize governments. The 1772 crisis bankrupted thousands of ordinary families across Europe and directly contributed to the economic conditions that made the American colonies rebel against Britain just a few years later. I want to be clear, this isn't financial advice. The goal is to show how shadow banking crises unfold using history as our laboratory. Understanding this pattern reveals how your savings, your job security, even the stability of your country depends on systems most people don't know exist. Shadow banking operates in the gaps, the spaces between regulations where credit multiplies without safeguards. When it works, it fuels growth. When it fails catastrophically. The potential winners are those who see the pattern before it breaks, investors who move to safety, policymakers who implement smart regulations, everyday people who protect their wealth before the crash. The losers, everyone caught unaware when the music stops. Central banks, policymakers, and financial institutions all play roles in this drama, but this isn't a story about simple villains. It's about systemic incentives, human psychology, and mathematical inevitabilities that repeat across centuries. By the end of this, you'll understand why shadow banking keeps coming back. No matter how many rules we write, the three main drivers that caused the 1772 collapse, and why they're present today, how a crisis in one small corner of finance can cascade globally, and the surprising ways these crashes reshape entire societies. The secret isn't that history repeats, it's that we keep building the same vulnerabilities into our financial systems, just with fancier names. The core of shadow banking is deceptively simple. Credit creating more credit, beyond anyone's direct oversight. In 1772, this was called bill kiting, or circular credit. A Scottish banker named Alexander Fordyce would issue a promissory note to a Dutch merchant. The Dutch merchant would use that note as collateral to borrow from an Amsterdam bank. That bank would then deposit the same note with a London bank as security. The London bank would lend against it again. One promise to pay had now generated 4 or 5 layers of credit, all resting on a foundation that might not even be solid. Think of it like this. You write an IOU for $100 to your friend. Your friend uses your IOU to pay someone else, who uses it to pay another person, who deposits it at a bank that lends against it. Suddenly your $100 IOU has created $500 in economic activity. Great for growth, until someone asks for the actual $100 and discovers it doesn't exist. By 1772, the European financial system was a house of cards built on these layered promises. Historians estimate that for every gold coin in circulation, there were 10 to 15 paper promises claiming that gold existed somewhere. The modern equivalent? Collateralized debt obligations, repo markets, and derivatives. In 2008, banks took mortgages, bundled them, sliced them, used those slices as collateral for more borrowing, and repeated the process. Shadow banking liabilities reached $22 trillion by 2008, operating with minimal reserves and little transparency. But unregulated credit alone doesn't cause collapse. It creates vulnerability. What triggers the actual crisis? Leverage on speculation. Both 1772 and 2008 had the same fatal combination. Borrowed money poured into assets that couldn't sustain their valuations. In early 1772, the hot investment was East India Company's stock. The company controlled India and had a monopoly on Asian trade. It seemed rock solid. Scottish bankers like Fordyce borrowed heavily using circular credit to bet big on those shares. Human psychology comes into play here. When prices rise, more people borrow to invest, pushing prices even higher, encouraging more borrowing. It's a self-reinforcing loop until it isn't. By mid-1772, East India stock was wildly overvalued. Smart investors started selling. Prices wobbled. Fordyce, who had borrowed enormous sums, faced margin calls. Rather than admit losses, he tried to corner the market, buying more shares with borrowed money to prop up prices. It's like trying to hold up a collapsing building by pushing harder on the walls. The structure's integrity is already gone. The 2008 parallel is obvious. Housing prices fueled by subprime mortgages, with banks leveraged 30 to 1 or more on mortgage-backed securities. When prices stopped rising, the whole structure crumbled. Lehman Brothers, Bear Stearns, they faced the same choice Fordyce did: admit reality or double down. They doubled down. We know how that ended. Leverage turns small problems into existential crises. A 5% decline becomes a 50% loss when you're leveraged 10 to 1, and total bankruptcy at higher ratios. Then there's interconnected contagion. Localized problems become global catastrophes because everyone owes everyone else. When Fordyce's bank failed in June 1772, it didn't just affect his depositors. The Dutch merchant couldn't repay Amsterdam. Amsterdam couldn't repay London. London banks faced runs. Within weeks, credit froze across Europe. The Bank of England nearly collapsed. The economy seized up, not because there was no wealth, but because no one knew who could actually pay. Trust evaporated. Think of it like dominoes stacked in 3 dimensions. One falls, entire sections collapse. In 2008, this happened with counterparty risk and derivatives exposure. When Lehman failed, everyone who had contracts with them pulled back, which made others pull back. Credit froze worldwide, even for companies not tied to subprime mortgages. Interconnection alone isn't the problem. It's the opacity. No one knew who was exposed to what. That uncertainty multiplies the crisis. With unregulated credit, leverage, and interconnected contagion, catastrophe was inevitable. The aftermath teaches even more about what we're risking today. The 1772 crisis triggered a wave of regulation, but with irony. Britain passed new banking rules, yet the wealthy continued to access credit under the radar. Small merchants who relied on flexible credit found themselves cut off. Regulations designed to prevent speculation ended up constraining productive activity, while speculative capital found darker corners to operate in. Observers noticed the crisis widened the gap between elites and ordinary merchants. Those with insider connections survived or even profited, while thousands went bankrupt. In 2008, the Dodd-Frank Act created thousands of pages of rules. Big banks faced stress tests, yet shadow banking migrated to less regulated sectors. By 2023, it had grown to over $200 trillion. Crisis leads to regulation. Regulation squeezes small players, sophisticated actors find loopholes, and power concentrates further. Another consequence: political upheaval. The 1772 collapse contributed to the American Revolution. When British credit markets seized, the East India Company lobbied for a bailout. Parliament passed the Tea Act of 1773, granting a monopoly on tea in the colonies. Colonial merchants, threatened by the monopoly, staged the Boston Tea Party. Shadow banking speculation in London, crisis, corporate bailout, revolution. After 2008, we saw this globally. Occupy Wall Street, populist parties, Brexit, anti-establishment movements, all tracing back to perceived unfair bailouts while ordinary people suffered. Financial stability isn't just economics, it's the social contract. Finally, the innovation paradox. After 1772, financiers created instruments to spread risk, which reduced some vulnerabilities but increased system complexity. By the 1820s, these safer mechanisms enabled bigger bubbles and crashes. Today, credit default swaps, algorithmic trading, CLOs, blockchain, all innovations partly meant to improve safety, add complexity. In 2008, even banks couldn't value their own assets. Complexity itself becomes a vulnerability. Regulatory whiplash, political instability, ever-growing complexity. Have we learned anything, or are we running the same program with faster computers? Remember that London merchant in 1772. The moment of realization, money that only existed as promises, captures something essential about shadow banking.